evening, everybody. My name is Don Kaufman. I want to welcome everybody to this night's presentation, The Next Big Short over here. Going to run you through a couple of things, but we're going to jump right into it. I think you will find tonight's presentation extremely in-depth, educating, and, well, let's jump right into it. So, The Next Big Short, again, brought to you by TheoTrade. I throw up a disclosure initially here, and the reason we pull this up is because it says we're not financial advisors or a broker-dealer. For those of you that may or may not be aware, I spent the previous 15 years of my career in the brokerage industry. Prior to that, I was a trader. So I always like to throw up the risk disclosure. I am no longer part of TD Ameritrade or Thinkorswim. That's me. Sorry, it was an unshaven picture, but I'm co-founder here of TheoTrade. I have been in the trading arena really all my life. So I started trading in the late 90s, officially started trading in the late 90s. When I say I've been around it my entire life, I actually came from a family of traders. And they weren't just like market makers. I actually had an uncle that was owned a trading firm out of Chicago. Eventually, that firm was acquired by the Swiss bank in 1992. Anyway, I joined into the trading ranks in the late 90s, literally 3 weeks out of college. And about 2.5 years after trading, I was invited into a small startup firm. Nobody knew it at the time. It was called Thinkorswim. When I say nobody knew it at the time, nobody knew eventually that firm would sell for $600 million to go public. And then, of course, we were acquired in 2009. We got scooped up in 2009 by TD Ameritrade. I spent, again, the beginning of my career predominantly at Thinkorswim, building some of the technology, but I also ran their education division. Then I went on to run institutional education at TD Ameritrade, and then eventually they gave me the entire retail education side of TD Ameritrade and their 7 million clients. And I'll discuss that a little bit as we kind of cruise forward this evening. Done the CNBC appearances. I'm not a really big advocate of kind of mainstream media, but I do like to throw this up there because they pitted me against Mr. Wonderful himself. And one of the sayings, I've grown up again around trading, and one of the sayings kind of is, trading, it's never about being right or wrong. But when you're up against Mr. Wonderful, I was right. I was in the right. So I shorted Apple up in the 130 handle. Covered it at 110, reshorted it, and wrote it all the way down to about $89. A lot of you guys, if you've followed me for the last couple of years, have actually seen some of the trades over there. But Apple's one of the more memorable ones because, they got it on film. So me pitted against Mr. Wonderful himself. So let's jump into this, risk and success, because tonight we're going to talk just about that. We're going to talk about your risk, your success in the marketplace. Clearly, there's been a couple of days where, the markets are kicking up a little bit of dirt, a little bit of dust right now. And I think that this slide will resonate with you possibly right now more than it has in quite some time. But one thing I want to get you thinking about as we kind of roll into this, because you're like, well, what is this all about? What's the big short over here? Well, before we dive head on into that, you have to realize how you handle your risk is directly correlated to your success in the markets. Too much risk, what's going to happen? You're going to panic, you're going to lose control of your positions, and of course you're going to continuously close those positions at the worst possible time. Now, I have to tell you, or maybe ask this question again. This is kind of an open commentary here in the Q&A. How many of you maybe felt a little bit of fear inside of the last 3 trading sessions? Friday, Monday was an up day. So Friday was the down day, Monday was the up day. Today you looked like this. By the way, this just emanates the last couple of days over there. And I always say, at least you're consistent with your panic. So one of the things I've been afforded to do over many years is I've watched order flow. I've watched order flow, not just like on the retail trading application. I've had the ability to watch order flow of 7 million retail clients at TD Ameritrade. It's the largest retail order flow in the industry. Number of trades per day, All right, in terms of the number of clients out there, it's huge. You learn a lot. And one of the things that you learn watching order flow of clientele and professionals at that is they have tendency to, everybody kind of panics at the exact same time. It's like watching a bad movie. You know exactly how it's going to end. It typically ends with something along the lines of this. Hey, but at least it's a Mac, right? With that, get ready. It's coming. We're about to embark on what could be one of the most pivotal periods in our market's history. Prediction of that risk, we believe here at TheoTrade, is relatively easy, but timing the onset of that risk, it's totally impossible. And I want to throw that to you right now. You know, the risk is there, and we're going to talk about that. We need to twist that risk, okay, in our favor. So tonight, we're going to present a strategy whereby you can harness the potential afforded to us by the current market environment. Specifically, I want to detail, okay, for very little capital up front, you're going to go out there, you're going to risk one to be potentially to make 10. With, again, very, very little upfront costs. So I'm going to take you through in the next 45 minutes the entire strategy, all the plausible risks, and how you can place these trades. So let's get right into it, because what I want to present to you, all right, without further ado, what I want to present to you is a strategy just in case we tank. But if we don't tank, it can't cost you a lot of money. And that's something you really have to think about. So we're going to put on a strategy that ultimately affords you the ability to have what's either called a hedge. What's a hedge? It's downside risk mitigation. If the market tumbles, you'll actually have a position on that could control risk, all right, of some of your other positions. Or how about you just think the markets might tank and you want some downside opportunity? And that's exactly what we're about to get into. Now, before we go head on into it, we got to recap a little bit about what we call the volatility or lack thereof. So let's start to recap a little bit about what volatility is, because again, when we're talking about the next big short, clearly the trade that we're going to be creating has a tremendous amount to do with volatility in the marketplace. So volatility in the markets. Have you ever spent time looking at the volatility in the markets and compared that to what you believe risk to be? All right. Now, when I say something like that, again, this is, you know, open for interpretation, but I want you guys to be able to answer. Look at two stocks. Look at two stocks here. I'll even put them up on your screen over here. So two stocks. Let's compare something like Google and Walmart. That's a G. I promise you it's a G. Google and Walmart. You tell me right now. Feel free to chat this in. Which one has more risk, Google or Walmart? Which underlying, okay, for all intents and purpose, has more volatility? What's got more risk? Volatility most notably measures risk. So which one of these underlyings has more risk? Okay. Don't cheat, because I've actually gone through examples like this time and again. All right. The behemoth tech stock or Walmart? I mean, come on, it's Walmart. Well, first, what's volatility and what does it measure? And by the way, I promise we're going to answer this. You know what's interesting over here? It's pretty 50-50 market. A couple of people saying Walmart. The vast majority, though, now are saying Google. Come on, these are not rhetorical questions. I know some of you are sitting there eating dinner, having a couple of drinks. Hey, let's make tonight a 2-drink minimum. Anybody? Volatility is equivalent to risk. So here's our first step towards option markets. Option markets. Now, you don't have to be into option markets. I don't care whether you're into options or not. But option markets can be thought of as putting a price tag on risk. One of the great things about option markets is the option markets, they're like literally hanging a sign on this is risky or not so risky. So pricing in the markets is determined via market participants. Ultimately, options pricing in the end comes down to supply and demand. You know, people will like worry about all these like crazy things like, do you want me to pull up the Black-Scholes model? I could do it. Don't make me do it. You know, they're like, that Black-Scholes model, and they get into these crazy pricing formulas. But in the end, what really prices risk in the markets? It's supply and demand. If everybody in the world right now demands options, guess what? Price of them goes up. Why? Because the price of options, option pricing, there's another word for it. It's volatility. synonymous with risk. But in the end, it's all about supply and demand. You don't have to worry about the Black-Scholes model and all the different, geeks out there that are pricing stuff. It's all about supply and demand. Now, a recap of volatility. So, implied volatility. Well, there's actually two types of volatility. There's what we call historical volatility, and there's implied volatility. Now let's start with historical volatility. It's the annualized standard deviation of the past stock price movement. Okay, the volatility that so many people that are familiar with markets, they always are like, oh yeah, the market's volatile, the market's volatile. Okay, but let's say, for example, yesterday. Okay, what was yesterday? It was Monday. What did the markets do yesterday? They went up big. But if you looked at option volatility went down. Why? Because option volatility is all about risk, but it's really about risk to the downside. People don't freak out in fear. Oh, we rallied. Oh, it killed me. No. People panic when the market sells off. So when you're thinking about volatility, okay, volatility and risk, again, are synonymous out there. Now, let's really explain volatility, because volatility, it eludes so many people. First of all, volatility is always quoted in percentage terms. There it is right there, right? So somebody comes out and they go, yeah, option volatility is 20%. And so few people know what the 20% really means. It's such like an esoteric number. Oh, it's 20%. Yeah. And you're like, it sounds good, the cocktail party. But what option implied volatility is? Implied volatility, again, the word implied in front of volatility means the what? Option volatility. That's what implied is. Because implied is the future. Options are pricing the future risks. That's what they're doing. You have an option a month out. What is it doing? It's trying to put a price tag on risk a month from now. So when you start looking at vol and it says 20%, okay, it means that product, when I say product, that's stock. What is this? This is a stock. What stock do you guys want it to be? I have the best nickname for every stock. I call it stock. All right? So every stock from now on is stock. Instead of a stock, it's a stock, because that way it can be an index, it can be a stock, it can be anything. Because in the end, it doesn't really matter, right? If you are worried about what stock this is, what does it matter? What does it matter what stock it is? But it's Walmart. But it's Facebook. But in the end, it's just supply and demand. It's supply and demand in a couple of letters and a volatility. So what this volatility really correlates to, it says that this product can go up about 20% or down about 20%. Now, it's not always, it's not always going to stay in that range. It's going to stay in that range about 68% of the time. And you're like, he pulled that 68% out of thin air. That's on his slide. It actually has to do with what's called one standard deviation, right? Everything kind of fits into standard deviations. The first thing you should think is, what happens out here? What happens out here? Well, could this $100 stock go to $5? Sure, it can. But probability says it's going to stay inside of this range. And what options are good at, options are like pricing, the forward future, and they're really, really good at it. Now, why do I take the time to talk to you about volatility? Okay? Dun, dun, dun. All right, back to our question over here. Let's get right to it. We're going over to a trading application. This trading application happens to be none other than Thinkorswim. You don't have to use Thinkorswim, okay? I won't hold it against you. We're looking right now at the spiders. It's a spider. It's the S&P, but what was the question earlier? It had to do with Google, okay? So let's go look at Mr. Google. Mr. Google, on the right-hand side of your screen, you will find what are called the implied volatilities. Right in this little monkey right here. Implied volatility, 23%, 18%, 17%, 19%, right? So those are your implied vols. So roughly speaking, let's call the average implied volatility in just the next few weeks, the average risk metric. And this is what's so cool about options. Options volatility levels the playing field. Now that statement, people don't really get what I'm saying. When I say option volatility levels the playing field, why does it level the playing field? Because you can look at the implied volatility of Google, right? And 1 second later, you can go look at another product. What product do you guys want to look at? Let's go look at Walmart, because now we know that Google's implied volatility is around 18%. Now, we're going to go over here, go backspace, 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 WMT, enter. And Walmart's implied volatility is about 20%. Now, there's, a brief pause over here, okay? A brief pause. Why a brief pause? Do you realize that a major big box retailer, it's Walmart. Have you looked at Walmart's stock? Okay, just bear with me again for a second over here. Here's Walmart. That's the last 5 years of Walmart. It's 5 years of Wally World. 5 years. What has it done over 5 years? Absolutely nothing. Have you looked at Google in the exact same time period? Oh, let's go look at Google. Here's Google in the exact same time period. Yeah, it's gone from, let's call it $250 to 788, even 813. So why in the world is the implied volatility of Google the same as Walmart? I got even a crazier question for you. Take a look at the XLF, the financials. If you don't know what the XLF is, that is A-okay with me. But the XLF, the financials, which is all the financials combined, they have higher volatilities. Okay, this is a major index product, people. It has higher volatility than does Google. Kind of strange, right? Yeah, something is strange in the world right now. There's no fear or loathing on the street. The degree of complacency in the markets, considering we term the myriad of tail risks on the horizon, it is ridiculously remarkable. Now this happens to be a screenshot, and if you look very, very carefully when I took this screenshot, okay, it happened to be on September 2nd. Now, I prepared this stuff pretty far in advance, and the reason I did that is, well, I wanted you to see today. If you see the VIX today, it doesn't mean that, volatility, it's shot through the roof. It's getting crazy out there. It's, picking up, though, a little bit. So I took that screenshot right over here, all right in this neighborhood over here, and here's the volatility now today. So it picked up a little bit. Things are getting interesting, all right? And I just want to bring to you the issues. We got a lot of issues with you people. We got a lot of issues right now. And the one thing that just stands out, all right, is you have to step back from like trading or looking at markets every day. Because people come home from work and they look at the markets every day and they're, well, it went down. Well, it went up. Step back from the day-to-day picture. Look at the big picture here. Think big, broad strokes. Think over the last 5 years. Why? How can the financials, all of them conglomerated, equal more risk than one product? Do you realize if the Google CEO hops in a plane, Eric Schmidt hops in a plane, the plane crashes, do you think you do not have more risk in Google than you do in every financial product? Do you realize that Google's risk right now is lower than Walmart? People don't think we have issues. And I'm going to show you exactly what's going on over here. We've got issues. First of all, here are what we call the looming risks. This is some of my favorite stuff to talk about. So bear with me. This is good. The FOMC and the central bankers' interest rate policy. It's one of the major risks out there. Central banks buying of corporate debt and ETFs. You have to realize something about the central banks. Okay? The central banks are going out there right now and they're buying corporate debt. Specifically, I'm speaking of Mario Draghi and the ECB. That's the European Central Bank. They're literally going out there and buying corporate debt. That means a company, I'll give you an example here in the US. A company like, let's say Apple, goes out and they can do debt offerings. They could just say, I need $1 billion, please. And you know what? They get the $1 billion. And right now, for the first time in the history of markets, did you know that a corporate debt offering in Europe went to negative rates? That means the company gets to borrow money and gets paid to borrow money. Who pays them? The ECB. Oh, no, that's not ridiculous. That one, it's skated by most of the press releases because nobody understands this. It allows no price discovery whatsoever. That company could do whatever they want with the money. It's like Apple going out there and getting $1 billion. What do they want the $1 billion for? Let's buy back our stock. Why? Because we didn't have to pay anything to buy back our stock. Because we got to borrow the money for free to buy back our stock. Why do you want to buy back the stock? So I get a bonus at the end of the year. It just goes on and on. Presidential race, followed by change of administration. That's one over there, $11 trillion of negative yielding debt. It's picking up right now, too. The negative yielding debt, well, let's actually poke, specifically the negative yielding debt. Japan, they kind of started it, but it's picking up now all over the world. So Japan is like, if you will, the petri dish of quantitative easing. It's quantitative easing gone awry. And what we're looking for the coming weeks, the coming months, okay, we actually believe in a huge amount of our research that's been done that traders and the markets are about to turn their backs on the central bankers of the world. They're going to look at negative yielding debt. You're starting to see more and more trading turning around and saying negative yields are a very bad thing. Chinese debt. Oh, it wouldn't be fun if we didn't look at looming risks in China. 270% of GDP. That's their current debt. That's what we know of. By the way, China just came out with a really positive report about their economy today. You know what it said in the report? It said that the China Federal Bank in China went out and they spent so much money that they actually boosted their economy. Yeah, and the Chinese banking system grew 1,000% in 10 years. That number does not include what we term shadow banking. The shadow banking, nobody knows how large it is. It could be 2 to 3 times, meaning the banking system could be 2 to 3 times the literal banking system because what they have was called shadow banking there. It exists here in the U.S. too. Now, throw on top of it 1.3 trillion in student debt. The number doesn't scare me. The 42% delinquency, postponed or in default, that's out of control. Brexit, that's, neither here nor there, but it's going to have global currency devaluations. The currency wars are on right now. Japan is doing everything they can to take the yen and crush it. And yet the market's done nothing but make the yen rally. Brutal. Then I had to throw this in here for my own personal amusement. WikiLeaks. Why? Because WikiLeaks has promised to destroy one of the candidates during the presidential race. When is it going to happen? Late October. Oh, don't forget. And as a correction on the bottom, they're not looming risks. They're all current events. Every one of these is live right now. These are real events. These are live. These aren't looming risks that we don't know about. These are not, when we talk about tail risk in the market, you usually think about unforeseen or what they call black swan events. All of these, okay, are real. So how the heck can the market, how can the VIX not be seeing this? There's a specific reason for it. It's suppression of risk. Here we go. Let's start pointing the finger. The Fed, the Federal Market Open Committee. Yes, Janet Yellen. I don't necessarily blame Janet Yellen, but the Fed. Let's talk about suppression of risk. Central banks produce volatility suppression. This is some complicated stuff that we're getting into now. We getting interesting? Anybody? The FOMC, okay, Janet Yellen. Central bankers around the world. Now, the central bankers, that can include Bank of Japan, that can include the ECB, which is the European Central Bank, that can include our Fed, right? I don't know exactly what to call the Chinese banking system. It's part of the government. It's all intertwined over there. But banks, proprietary trading firms, okay? What's a bank? Like what? B of A, they're a bank, okay? B of A is a bank. Yeah, but they're also B of A Merrill. Okay, Goldman Sachs. Is it a trading firm? Is it a bank? It's both. Technically, Goldman, back in 2008, registered to be a bank. But banks, proprietary trading firms, hedge funds, anywhere in the world. Did you know they can borrow capital for near zero interest? It's just a carry trade. They can go out and they can borrow as much money as they want. Hell, they leverage, highly leverage. The world financial systems, they are bursting with cheap money. Okay, one of the things that is a byproduct of negative yield and no interest rates, I mean, that's what we're at, right? Zero interest rate. One of the byproducts is what stops, okay, all the trading firms in the world from borrowing capital at near zero interest. So what do? They go out there, negative interest rate policy even is forcing lending. And all of this stuff is by design, okay? We're bursting again with capital. And what it causes is trillions and trillions of dollars seeking returns. So a global financial system flush with free money, it's causing asset managers and traders to seek returns anywhere. Now, think about this for a second. If you put money into a mutual fund, the way to actually present this to you is don't think about proprietary trading firms and stuff like that. Again, I come from that kind of professional trading world. It, immediately clicks with me like all these trading firms, they're flush with cash. They don't even know what to do with it. But here's the way that you guys might understand. If you have a 401k, an IRA, if you have any type of mutual fund, if you look at the prospectus of the mutual fund, it's that piece of junk you throw in the garbage every quarter that you get it, right? They're required to send it to you. All right, they are required to send it to you, and most of them have to do it in physical, like you get a big packet in the mail. You're like, that's a nice piece of crap, and put it in the garbage. Have you ever read one of those things? Maybe, maybe not. In the prospectus, it specifically says if you put money into the mutual fund, that the fund has to work 95% of the capital. That basically means if there's inflows mean people are putting money into the mutual fund. Let's say that there's $1 billion of inflows to some mutual fund. Do you know they have to put 95% of that capital to work immediately? They can't fall below the 95% threshold. Now, imagine if you're a hedge fund, you're a derivatives firm. They have similar kind of bylaws inside of those firms. So what do they have? It's a glut of capital. It's smashing volatility. Market participants, they're throwing caution to the wind. They don't give a crap. Throw caution to the wind in search of returns. You have to. You have no choice. That's what people don't get about this entire glut of capital. They have no choice. Shove the money down the hole. It doesn't matter. Markets are irrational on free money. Money pouring into the financial system, it's inadvertently suppressing volatility, and it's inadvertently suppressing price discovery. That's a big one. When I say price discovery, you don't know what something is really worth in longer duration. On a broader time frame, you need to just completely forget right now. Charts and technicals, throw them out the window. I know that people get upset when I say stuff like this. I've been called over the years. Listen, I am a quantitative trader. I grew up around quant geeks. But I'm telling you, charts and technicals, you don't have to worry about them right now. There's no technical indicator that's going to say, this is it, we're going to break down. Because everybody has to throw caution to the wind right now. They don't care. They have to put money to work. So we bubble up, we bubble up, we bubble up. Fundamentals, though, become meaningless. Why do fundamentals become meaningless? Well, when you're giving debt to companies for next to nothing, and again, Apple is the perfect example. Apple went over and did a European debt offering. So think about Apple. Everybody knows it. I downloaded iOS 10 today. It's like iOS 9, except it makes different noises. Ooh, but still my heart. All right, that was 1.1 gig of a download that I could live without. But fundamentals are meaningless. And the reason to show you this, so Apple goes, and instead of doing a debt offering here in the US, they did a debt offering, okay, about 18 months ago in Europe. Why did they do this? Okay, because they're pretty sharp little monkeys. They did a debt offering in Europe and then converted the debt offering, okay, through a currency swap, and were able to actually make money on the debt, meaning that they borrowed several $billion, and instead of paying interest, they're actually going to come out ahead, all right, in a currency swap deal, which allowed them to just take the money and do whatever the heck they want with it. Who cares? You pay it back one day. Ooh, very slowly. There's zero interest rate on it. So at that point, what do? Throw caution to the wind. That's what everything is going on. That's why fundamentals, throw them out the window. It just doesn't matter. Like, when it does start to matter, though, everybody's going to go to companies that have cash. Like, if you're not making money, you're going to be in serious trouble. Additionally, volatility readings, they're totally deceased. And now this goes right back to what we talked about a little bit earlier. When I say volatility readings, you got to start looking at individual stocks to get a handle on this. You start looking at stocks out there. You look at Facebook. It has 22%, 23% volatility. So Facebook, okay, what does it do? We don't even know yet. What does Facebook do? They advertise. What do they advertise? Stuff. Okay, Facebook, one company, okay, built by a kid, has a lower implied volatility or equivalent implied volatility to the entire financial sector. Oh, yeah, that makes perfect sense. Wait. Let's look at the XLE. If you don't know what the XLE is, it's the energy sector. The energy sector, the entire energy sector. Do you know what the primary product of the XLE is? It's ExxonMobil. The entire energy sector, which has seen some volatility lately, but the entire energy sector has a higher implied volatility than does Facebook. Things are totally irrational right now. And and this is where people like gulp, you know. But on the bright side, it's all about opportunity. The opportunity here is absolutely phenomenal. Suppression of risk presents opportunity. You can't look at this and just think to yourself, that's it, I'm going in the bunker. I'm underneath the desk right now watching this presentation. Will anybody admit to grabbing the monitor off the table, getting underneath the desk, putting a helmet on and watching it on the monitor, gripped around? Huh? Anybody? I like what somebody said, Apple paid no tax to boot. This is true. Now, the opportunity over here. Suppression of risk presents a huge opportunity. Risk is good. All of these issues, you have to recognize them for what they really are. If you identify them, they're opportunity. You're going to have a strategy whereby you're not going to substantiate inordinate risks. So you don't want to basically put your neck on the line, because here's the whole thing. We know what the risks are, right? So we're pointing out risk after risk, the suppression of the risk, yada, yada, yada. But the problem is you don't know when the onset, all right? There's going to be an onslaught of volatility. And we just don't know. Maybe Friday kicked it off. I mean, most people that are in here right now, you probably were, a little nervous over the last couple of days. I'll tell you what, every one of you, whether you're long or you're short, okay, felt the fear in the last 3 days of trade. And if you didn't, you're lying. Okay? Listen, I've been doing this for almost 20 years. My positions are sizable. Yesterday, listen, I'm a huge short in the market right now. Yesterday, did I feel a little bit of fear? I wouldn't call it fear as much as like apprehension. I'm like, wow, we're going up almost as much as we went down. Every one of you feels the fear, though. And you got to substantiate strategies if you see those risks, but not take inordinate risk. Put it bluntly. We want to buy the heck out of volatility. We want to buy volatility as if it's going out of style. We want to buy volatility as we believe future market risks are formidable. Even if you don't believe the risks are forthcoming, can you please accept the relative dangers and mitigate your exposure accordingly? Okay? And that's where I actually like begging people. I have been through this time and again. I've watched 7 million retail clients trade. And everybody's in like disbelief. Nothing's going to happen. Yeah, until it does. Or another way to put this. The last 7 years, we've pretty much been straight up. The last real volatility lasted 3 or 4 days on August 24th in 2015. It did. August 24th in 2015, a 7% move in 1 day. That's the last real risk. The last real bout of risk, true risk. You got to look back to almost 2012. Sure, the beginning of this year got a little bit wild, but the risks are clear here. We can see the opportunity. Yet how are we going to go about buying the vol? We got to buy volatility. You can buy volatility-based ETF products. This is common knowledge. All right? We can buy volatility products in today's marketplace. However, volatility-based products are riddled with failure. I know that you guys want to hear about this, but the VXX, they're volatility exchange traded funds. Here's the two prominent ones, the VXX and the UVXY. Okay? The VXX over the past 6 months. I didn't get crazy and pull up 5 years. I just pulled up 6 months. I was being kind. It lost, that is correct, 63% of its value. But wait, it was up a little bit. All right? These things are terrible. They don't do what you think they do. They were never designed to do what you think they do. People buy them. You're down 63% in the VXX in the last, what? That's 6 months. If you actually held this for a few years, you're down 99.9%. The UVXY, for those of you that know this product, it's in a complete and total death spiral. It has legitimately traded from 168 to 17 bucks. Now, you got to show this today, because today, all right, you want to see something crazy? UVXY. Today it moved up. Now, today was a big volatility day, people. Here's 9 months. It moved in the last 9 months. And again, you know, can't make it up. This is the chart. There you go, 300 bucks. The low was 16, but today it's back to 24. Oh, it's had an amazing rally. Rally, please. Just in the last few weeks, though, it's still getting crushed. It's trying to come back to life until it fails miserably. It is a highly flawed product. Highly flawed product. And again, I can't stress this enough. This is not a product per se that you want to get yourself involved in. You know, so when you look at a product like that that's down 89%, that's in the last 6 months, recognize, okay, it popped up today, but not nearly as much as people would have expected. You're flushing your money down the toilet. Volatility-based ETFs is the fastest way to lose money. And for those of you that don't know the term, it's because of contango. You cannot succeed buying volatility outright. Why? Everybody else have already thought of that. You can't buy volatility outright because the market sees these risks in the future. You got to be smarter than your competition. And that doesn't mean, okay, that doesn't necessarily mean that you got to be like a brilliant strategist out there. If you think of, like, again, millions and millions of retail clients, you just got to know a little bit more. Positioning your portfolio for a big move. So let's get to the down and dirty over here. How do you position yourself most effectively for the possibility of an extreme move, yet without exposing yourself to drastic risks? Don't get cute. It's pretty serious stuff, okay? There's going to be a lot of capital up for grabs in this. And when I say don't get cute, you know, what do you think you're going to do? It's, again, we just learned you can't buy volatility. You're going to get crushed. Everybody that goes out and buys the UVXY, and people are like, well, can I short the UVXY? No, because they're going to actually hit you with what's called hard to borrow fees. Come on. All right? This is business, and every scenario is being looked at out there. So you can't get cute out there and try to buy volatility. We're going to do what's called risk twist spreads. You can employ a ratio type option spread to an index, okay, and equity products known as a risk twist spread. I mean, literally in the name, what I'm trying to do with this strategy is twist risk in our favor. The idea is really easy. You gotta and go after and achieve maximum reward for minimal upfront cost. And this spread, this risk twist spread, it just screams limit your exposure and maximize your potential. And that's the design. This is a risk graph. Okay, if you've never seen a risk graph before, all right, I'm just going to take you through it briefly. It happens to be specifically on the spiders. Okay, what you're looking at is this risk graph was actually taken, the screenshot was right here. That's the underlying price. So this product again is the spiders, and the spiders, when I took this shot, we're trading at $218.72. This is not a simulated trade. It's a live position. I'm going to show it to you in my account here momentarily. And what you can see of this spread, this is how much the money the spread can make. It can make 1,000, it can make 2,000, it can make 3,000. It could lose 1,000, right? It can't lose 1,000. Look where the risk graph is. The risk graph, again, screams not much risk, lots of upside potential. But for the huge upside potential, what does the market have to do? Market's got to do what? It's got to tank. Again, limit the exposure, maximize the potential. And we're out there and we're swinging for the fences with this. But again, we're not going to get crushed. We're not going to get hurt if the thing goes against us. And I'm actually going to show you the spread. Like, I'm not going to leave you hanging over here, because one of the things that kind of scares me, we did a session last week, a very similar session to this. And I thought to myself during that session, I go, what happens if I present this and the market tanks like in the next 5 days? And literally 2 days after doing it, Friday hit. I did it last Wednesday, right? We did a session last Wednesday, and some of you guys even saw the session last Wednesday. And literally 2 days after that, right? That was on Wednesday night. It's like a day after that on Friday, markets tank. And I must have gotten 150 emails from people like, I think I need that. I'll take 2 of those. In fact, if you want to see the strategy right now, it's in the spiders. I'll go to the spiders, close up this left side bar here. I'll go to the Analyze tab, and if you're curious, like the spread, is it making money? Yes, it's making money. I will show you the exact spread in a moment. Don't let options intimidate you, okay? I'll show you every single step for this spread. The spread's up about 100%, okay? I'm not like killing it out there, but again, I've taken the risk off the table in this particular trade. And this, it's only one contract. It's only what we call one unit of the trade. I'm not, exemplifying huge risk in any way, shape, or form. So again, huge potential, minimal risks. Here's some of the characteristics of the risk twist spreads. It increases in value when exposed to heavy volatility. It's a highly volatility sensitive strategy, right? So when it's exposed to heavy volatility, it increases. It increases in value when markets sell off. Markets tank, it's good. It's good, eh? Right? The significant profit potential in a downside move, which ties directly to sell-off and volatility. Loses minimal capital if the markets rally. Hey, you know what? One of the things I started with today is this. I can't tell you when the onset of risk is. And if anybody thinks they can, it's ridiculous. That's what the whole entire world is trying to do right now. Everybody gets on CNBC. Oh, what do you think? What do you think? Let me tell you what they think. It doesn't matter. What they know is zero. Nobody knows nothing. I know everybody. It's a big conspiracy. Well, guess what? I got buddies that work in some of the largest derivatives firms on the planet. They're just as confused as everybody else. I had a buddy that I talked to yesterday. He's like, can you believe that on Friday we moved down 56 points in the S&Ps? On Monday we move up 36. And I go, oh, just wait. We talked the other day. I go, just wait. This is, the first leg of some real volatility. But you got to realize you can't lose capital if the markets are going to rally, right? Loses minimal capital if the markets continue to drift, which they were doing last week. Again, I put this slide deck together before the volatility kicked in this week. Need only be placed a few times a year. The whole trade gets placed 4 times a year. And by the way, if you hadn't noticed, the trade's down below. Why not? I'll give you the trade. It's the perfect spread to reduce risk of a stock portfolio. Do you have a 401k? Okay, if you have a 401k, you have an IRA, you can actually take this strategy. Even if it's in a taxable account, realize you can actually use it in a taxable account against your IRA. But you can, in fact, trade this in an IRA. Yes, you can trade options in your IRA. Some people once in a while be like, my broker doesn't allow that. Oh, I got an easy answer for that. Change your brokerage firm. Because, come on. This is 2016, almost 2017. But it's 2016. I think it's time to up the ante, right? You can do one of these spreads in there. There's nothing naked, nothing crazy about it. This is also an excellent tool for those seeking large returns. Everybody is like, well, I don't have a huge amount of money. I don't have a big 401k. Well, if you want to take a shot in the dark and the markets tank big, you're going to kill it. You just put one of them on. All you have to do is put them on about 4 times a year. I want you to note, this trade's out in December. That is the spread. Okay, I don't hide the fact that what the strategy is. Okay, it's a 1 by 3 by 1. Selling 1, buying 3, selling 1. There is margin held on this trade, not too significant. Now, building the risk to a spread. Do not let the options intimidate you. There's people that are hopping on tonight and they're like, oh, I don't really have any options experience. I didn't say you had to have experience. All we have to do, okay, is just understand, okay, the basic logic of what an option happens to be, okay, and from there, it's literally like putting blocks together. I mean, if you can just picture some blocks in your head. All right, I know what a put is. We can actually guide you to directly what put to sell, how many puts to buy, what put to sell. Again, 1 by 3 by 1. We can tell you the right expirations. We can tell you when to enter these trades, when to take them off. But you also have to realize, and by the way, the whole spread, this spread down below is being done for a 90-cent debit. So this trade that's right there, 90-cent debit, right? That means if you do 1 unit, this is 1 by 3 by 1, that'll cost you $90. The whole thing will literally cost you $90 plus transaction costs. Yeah, there's transaction costs, but you can make, if the market comes off big, easily you can make $1,000. That's one unit. That's the whole idea. You know, I'm not one of these guys that goes, look, you can make $5,000. I'm telling you this. You may have to put that spread on 3 or 4 times. But if the market has one of those August 24th days, your spread's going to pop in value. That's the whole idea, that the spread pops in value. It's a shot. Okay? But you also have to look at this. It's a massive chainsaw. I mean, that's, to me, the best analogy for this spread. It's like the chainsaw of the marketplace. Used correctly, really effective in creating returns. Used incorrectly, you're going to lop off a couple of fingers. There's very definitive guidelines that you need to follow to enter and to exit this spread. Fear not the risk twist spread. You may not know options, again, or have limited experience in placing trades. We can show you how and when to place the spreads. It's a matter of a few hours. What we do here at TheoTrade, we create very detailed recipes, okay, for every single strategy, including these risk twist spreads. And I guess, again, the best analogy I can give you, if you went out there to bake a cake. Now, I'm not exactly somebody that, I can bake a cake, but I'd need a recipe to do it. And the thing that I never really got is, like, people just go out there and they just start executing trades over there. And I'm like, what's your criteria? What's your recipe? Well, when I go out there, I buy this and then I hope. Okay, hope is not a recipe. You wouldn't bake a cake without a recipe. Why trade without one? That's what we do here. TheoTrade, it's all about recipes in trading. Criteria, it's what we do. And again, I want to make this abundantly clear. The strategy, I share this all day long. People can copy and paste this strategy. I'll literally take the strategy, okay, and cut and paste it for you. It's just a matter of going in, go into the monitor tab over here, an account statement, and come in here. And by the way, yes, it's a live account. Just look back at like order history for a couple of days. And again, I don't trade the spiders all that much, so there shouldn't be a huge number of trades in here. Go into the spiders, go 7 days back, and you can copy the exact trades that I do. Why not? I mean, I don't mind sharing trades with anybody. I can copy any one of the spreads that are in here. So come over here and, create closing order, flip it around. Again, copy the trade, share it with you guys in a matter of an instant. Come on. I don't know what it is with this thing today. I think Thinkorswim is a little bit slow today. Anyway, with that, and I'll be happy to share trades. I mean, it's what we do, but building this criteria, step by step, entry and exit criteria for every single strategy. I mean, because trading, it's about answering the what ifs. What might be a good stock or ETF candidate? Clearly, I just showed you the spiders, and I have one on, so I'm pretty sure that you recognize that the spiders might work. And again, somebody was asking about the P&L on here. So the one trade is up like 100%, but the market hasn't even dropped like a couple percent. We dropped from 218 to 213. That's it. It's a $5 drop. It's a $5 drop inside of the S&Ps. Again, we haven't done anything yet. So give me a couple of days and we'll do something. And sure enough, this thing will start to widen out. But as I say, trading is about the what ifs. What is the correct options expiration cycle to buy my risk twist spread? You saw me use December. How much capital do I commit? Allocation. If you want to learn how to hedge a portfolio, or how much capital do you commit based on like $3,000 account or a $5,000 account, make no two ways about it. Capital allocation, okay, is preeminent. One of the things we constantly talk about here and harp on at TheoTrade is there's 3 primary areas, okay, and kind of what, our discipline. The primary focus of everything you do, the first thing you think about is what your trade logic is. The second thing you think about is capital allocation. The third thing you think about is what do I think is going to happen in the market. The preeminent idea over here is you better learn how much capital to commit. Too much capital, obviously you're going to have a lot of your account at risk. Too little capital, you're not going to get a lot of bang for your buck. What strike prices and how many? I mean, that's key because this is a 1 All right, it's a 1/3/1 ratio. But you need to know which options, how far, okay? What options do I buy? What options do I sell out there? Again, that's what trading is. We answer the questions. What's the right probability? How many option contracts do I trade for the account size? When do I close my spread? The thing's up 100%. Do I close it? Not even close. Come on, we haven't even had like what, a 2% sell-off over here. Call me when we're really rocking. What if the stock sells off big? That's a good question. It's probably good for me. What's the correct return for the strategy? You need to know precisely when to exit it. What if the stock rallies massively? Can I fix a losing trade? Okay, that's what we have answers to. TheoTrade has your answers to all the trade-related questions. We build extremely detailed recipes with definitive criteria and checklists for each strategy. And a checklist means just that. Like a pilot, before they're taking off, check. Am I looking at the right product? Check. When do I actually place the spread? Check. What expiration do I use? Check. What strike prices do I use? Check. What's the allocation? Every one of those is one of the variables that we answer in this. What we call the how, the when, the why, what price. It's just the beginning of the variables you're going to face with a risk twist spread. The secret's always in the sauce. Now, everybody thinks to themselves, and you can do this. You can go and you can read about these spreads anywhere, right? But think again. The strategy and the corresponding criteria requires the utmost attention to detail. And I just can't stress this enough. You can go on Google right now. Go Google what a ratio spread is. And they're going to show you what a ratio spread is. But this isn't exactly a ratio spread. I've actually twisted the ratio spread. And again, it's months of time that we spent fine-tuning this trade, all the setup, the criteria for it, and the approach and how you're going to select, okay, what criteria. You need to follow the steps to be able to build a trade. All right? Everybody want criteria for the risk twist spread? Huh? Yeah? Absolutely. And by the way, of course, there's, detailed PDF. In fact, all of this is available on PDF. Class is coming up. We've actually got a class called The Next Big Short. It's about the risk twist spread. It's Saturday, September 17th. That's this Saturday. It's a 3-hour class. It's 9 a.m. to 12 p.m. Central. I like to list Central Time. I don't know why. I worked in Chicago for years. But it's 9 to 12 Central Time, which is 10 to 1 Eastern Time. It starts a little early on the West Coast. And believe me, that's my fault. I intentionally did that. Why? I got little kids. It's a Saturday. I like to work, early in the morning. And by the way, I wake up at like 4:30, 5 o'clock in the morning. So I'm a little crazy that way. I am the trade instructor for this particular class. Now, we've got a lot of different instructors here. We have myself, I'm Don Kaufman. We have Doc Severson. We now have Jeffrey Bierman aboard, who worked with me at Thinkorswim and TD Ameritrade for many years. Tony Rago, our futures expert, on here. Okay. Again, we got a lot of talent on board now here at TheoTrade. This particular class, though, I'm doing it. I feel really strongly the risks are coming. Okay. Heisenberg, who writes a tremendous number of articles for us, put together that PDF file about some of what we call the myriad of risks. This class, it's going to be archived immediately and available indefinitely to you. All the entry and exit criteria, and I'm telling you right now, I gave you what the trade is. It's a 1/3/1. It's out in December. You still need entry and exit criteria in the checklist. It's made available to you immediately. The whole entire deck that I build, which is again, PowerPoint just like this. We'll put it in a PDF format, shoot it over to you. But there's also some really important aspects that we're giving you with the class. Yeah, the class is $197. Okay, I want you guys to think, how many people lost more than $197? I don't know, today. Okay, the vast amount of you. But one thing we recognize here is not everybody is necessarily at the skill level to understand the risk twist spread. So what we did is we're actually giving you the classes that are leading up to it. And I'm going to strongly suggest the risk twist spread. Listen, I've built a lot of classes over the years. I ran the education division of Thinkorswim. I built the education division of Thinkorswim starting back in 2002. I mean, I have built, 50, 100 different classes over the years. I ran the education division of TD Ameritrade. And the risk twist spread, okay, this is some of the most detailed criteria. It's not complicated. but it's a lot of very finite steps. Okay, and we just go through the checklist. But I want you guys to understand there's a little options 101. Like if you don't know what a call or a put is, options 101, it's going to get you in tune for it. We're also giving you options 201. Okay, this is like my decisions. I want to hand classes that prime you for this class. Additionally, because we see extreme volatility coming, the in-out spreads course, that is a course that I feel, okay, by far and large is worth the $197. For just a second, the in-out spreads course, what it does is it allows you to trade in the marketplace, okay, by mitigating your volatility exposure. It lets you get long and short and do whatever you want. If you've been to that course, phenomenal. Nevertheless, you will love the in-out spreads course. That alone is worth the $197. They're just included. Listen, we did these classes, the 101, the 201, the high probability. Some of the classes were done in April. Some of the classes were done in May. They're recorded. They're in the can. They're ready for you. You can start listening to them tonight. You want to go to every one of these classes, including the Risk Twist Spread class. It's theotrade.com/twist. That's theotrade.com/twist. And it's going to be a busy class, right? And generally, I'm going to run over a little bit. I think I'll be a little bit more than 3 hours. I hope that's okay with everybody. There's going to be a lot of questions that come up on this class. And again, the in-out spreads class, that's a 4-hour class. Options 101 is a 5-part series. The 201, I think it's another 5-part series class. There is huge time and effort. Every one of them, you get the PDF, okay, with all of these classes. And again, the in-out spreads course, that has been my go-to strategy since April. When volatility died out in the market, okay, I had to go to something because there was no premium to sell, and I'm a premium seller. Now we see again huge risks in the horizon. Talk about the risk twist spread, but the in-out spreads course is a portion of it. Here's what's actually portions of the course. This is the curriculum. You're going to actually learn to construct the risk twist spreads. Okay, obviously that's going to be a big portion of it. And again, the web address for it is theotrade.com/twist. Now, in this particular class, again, you learn to construct the twist spread. You're going to build a spread step by step. Okay, I'm going to help you build spreads. You're going to hedge your portfolio. So if you want to learn to hedge, okay, read market risk like never before. So we're going to give you a couple of insights about volatility I think you guys are going to appreciate. All right, again, the only thing we see is going to be some risk coming. And we're really going to turn a twist volatility, how it can really help you and not hurt you. So these trades are all about implied volatility, what instruments are right for it, and that the trades, again, they can be done in retirement accounts, minimal options experience. And again, if you have a small account, there is going to be margin held in the trade. But if the account has got more than, $2,000-$3,000, you're fine. As long as you have some options approval in there, you will be fine. Spread approval is needed, meaning you got to be able to buy one, sell one, but we can actually help you with that as well. Now, that's the class. It's coming up. It's this Saturday, and I'm telling you, most people lost more than $197 in like 5 minutes this morning, if not on Friday. It's been Mr. Toad's wild ride. That's why we're also offering, or would you like to access every class we have ever done at TheoTrade and access every class we will ever do for the next year? So there's one more kind of kicker in here. We offer this. It's theotradeagain.com/twist. And I go through this with you. But this is like a full-on mentoring program. Rather than just take one class, okay, for $197. Sure, we give you the 101, the 201, the high probability class, okay? It's all part of it in the risk twist class. This, what we ultimately do is for $997, we give you everything we're going to do for the next year and every single class that we've done up until this point. This is only a couple of them. There's a class called Surviving Extreme Volatility, an Iron Condors class. Every one of these classes has extremely detailed criteria. High probability with in-out spreads. We've discussed that. There's a covered calls for income generation. There's also an inverted class, getting short and selling premium against short stock positions. There's a weekly options class. There's options 101, options 201. And again, my personal kind of mantra class over here is sell premium and manage risk. And that, to me, is the preeminent class. That class, if you guys heard anything about me talking about the Greeks and so forth, that's worth $1,000 alone. Just that class is. And that is hardcore It's like a 5-hour class. There's even classes that lead up to it. That is as hardcore as it's ever going to get. Again, it's theotrade.com/risk. I'm going to answer a couple of questions, but I also want to bring up the not only the email, our phone number is on here, okay, but I want to go through again the next big short class and the differential here, because there's always questions that come up. Again, one of the things that continually comes up for $997, like, what do you do? Well, what do you get over here? It's every class. We've done 101, 201, 301, high probability trading, okay, guide to selling high probability spreads. There's also a spread related class that we did over here, okay, selling premium and managing risk, which I don't know why I listed $150 over there. I'm telling you that class alone is worth $1,000. Surviving extreme volatility. This is all the classes that we've currently done. And I have to tell you, there's also not just classes from me. Doc Severson is doing classes. He actually did a small account growth class where, again, it was about generating a small account, growing your account out there. He's also talked a tremendous amount about technical analysis. We have Jeff Bierman on board. I also will let you know this. This 997 lets you into our chat room every single day. And again, it's every single archive that we've done. So if you're, kind of confused, like, well, what does that really kind of entail over there? Well, I'm going to show you exactly. I'm actually going on to the TheoTrade site right now, as you saw that pop up a second ago. I'll go on to the TheoTrade site, and I'll show you exactly what some of the archives happen to look like. So this is our member site. Here's all the archives. So for instance, Doc, Jeff Bierman. I forgot to even mention Slim Miller. For those of you that don't know, Steve Miller is on board now, also with TheoTrade. So I am a bit of a quant geek. I'm an options geek. So what did I do? Surrounded myself with market technicians. You want to know about Fibonacci's. You want to know about market cycles and so forth. Steve Miller's your guy. Jeff Bierman lovingly knows more about technicals than most people will ever recognize. He's forgotten more than most people know. Doc is your resident options geek, as well as he's big into fractals, fractal energy over here. Everything, okay, is archived. For instance, here's the class archive. This is all the classes that we've done thus far. Okay, and I'm just giving you, again, vertical debit spreads, mini class, okay, top 10 skills for growing a small account. That's actually Doc. Fractal energy trading is also Doc. I only listed a couple of it, and we've even got classes if you're interested on Thinkorswim. Unleashing the power of Thinkorswim, which we've done a lot of that stuff, but small accounts, trading workshop, again, it's all part of it. In addition to it, it's every class that we're going to do for the entire next year. It's like there's no and, in, if, or about it. Every single class that we're going to do, we do a minimum of one class per month. We're actually pushing the envelope on that, though. We've done a lot more than one class a month lately. And again, at the very least, learn to mitigate your risk. Go to the Big Short class, learn to do the risk twist spread. Either you're looking for a shot to the downside or you're looking for a trade to mitigate your risk. If you want to see everything we ever do, and here's another aspect that I do want to cover about the 12-month, the full mentorship, when it comes to technical indicators, because I already see questions that are popping in over here. And this is important because a lot of questions come up in this regard. What about indicators? Okay, one thing I want to make totally clear. We do not nickel and dime people. We're not here to keep selling product. Hey, here's another class. Let's sell it for $100. Here's another class. Once you're part of TheoTrade, you're part of everything. If there's a technical indicator for a class, we'll give it to you. Okay? Doesn't cost. Listen, I worked at Thinkorswim, all right, and on Thinkorswim for 15 years. We've got people here that work with us that write code on Thinkorswim. It doesn't really cost us anything. I'm not here to sell indicators. It's ridiculous. Give everything for free. Share your indicators. In fact, here, you want indicators? I'll give you indicators. All right? I can share every one of our studies that we have already done. Here's like this, Theo RSI projection, okay? Doc loves it. It's got fractal energy, okay? And it's an RSI on top of it. There are some proprietary studies. And everybody's like, I got this study, I got that study. Oh, guess what? We've got our proprietary studies too. The only difference is we'll give them to you. Okay? And then we teach you how to use them as well. Because again, I don't like in the education industry constantly selling something. This is not going to be the latest, greatest. Oh, you got to have this. We're not here to chase a big, shiny, bright ball where we're like, oh, that's very exciting. We're here to get you people educated. By the way, here's some of the classes coming up in the next 12 months. We're going to talk about cash secured puts, calendar spread essentials. That's actually going to be Doc. Doc is the man in calendar spreads. Futures trading. I'm also a futures geek, but we also have Tony Rago. Tony's also going to be doing some futures classes for us. Pairs trading. Oh, yes, the final frontier. I'm a pairs trading guy. Intraday trading. Weekly options for gamma explosions. Technical trading. That's going to be Doc, okay? And it's going to be Jeff Bierman. They're going to do some technical analysis. So if you know nothing about reading a chart, okay, we hired some of the most experienced market technicians I could find. Because I'm going to tell you, I know after 18 years in this business, my own strengths and weaknesses as a trader. And one of the things I'm not into charts. It's okay. I'm an anti-chartite. I stand up and I'll say it. So I surrounded myself with a couple of market technicians out there. There's a lot of them. Yeah, not too many of them have 42 years of experience. Steve Miller does. The guy has 42 years of experience. Okay? Yes, it's the same Steve Miller. He's been on shows it's not Steve Miller, the band. It's Slimmy. I've known Slimmy since I'm a kid, but it's the same Steve Miller. He's been out in the industry for years. He's phenomenal. Okay? All of that is archived. Jeff Bierman, it is the Jeff Bierman that worked at Thinkorswim and TD Ameritrade. Jeff was actually on a show with me for like 3 years there, 3.5 years. So intimately familiar with Jeff. He does a tremendous job in terms of market technicals. Then we've got Doc. So Doc goes back many years. He'll have over 100 years of experience in technical analysis. Okay, and that it's huge. So it's a little bit about the classes. It looks like we've got most of the questions. I love it. Somebody was asking about Cindy over there. I haven't talked to Cindy. So for those of you who don't know this, I ran a pretty good sized group at TD Ameritrade, the last group I ran. So here at TheoTrade, after we left the regulated world, I couldn't wait to get out of the regulated world. By the way, I still I like a lot of the brokerage firms, but you have to realize the brokerage firm industry, it's heavily regulated. And you just bogs you down after a while. So I left, and one by one, I've convinced people to kind of leave TD Ameritrade and, leave the firms. And I'm like, come on, you can come over here to TheoTrade. You can do what you want, say what you want, okay? And it's good. It's better. We trade live in front of people every single day, all right? And one of the last things I didn't mention that I should, when you actually do what we call Total Theo, it's the 12-month mentorship, we email you out our trades. Why not? We just email out the trades to you. So if you want to do a risk twist spread, I could just email it out to you quarterly, and we will. It's a huge portion of it. Somebody actually holds your hand and says, like, all right, this is what we do. We do coaching sessions every day. It's like you don't have to watch everything. I know some of you guys work for a living, so we'll email you the trades that we do. Need scans or studies? All the scans and studies, it's part of it. Real trade examples, we send those. Okay, and everything is archived all 24/7, including all the classes, all the PDF files, slide decks. You got it. So again, the risk to a spread class is coming up this Saturday. I'm excited about it, and I have to tell you, in terms of a class, I put a huge amount of. That's not me. That belongs to me though. So I put a huge amount of work into the risk twist class, and I can say, I've done a lot of classes. Again, I don't know, 50, 100 classes over the years. I've spent so long on the criteria for this. It really you put a lot of effort into it, and I hope you guys appreciate what's coming up on Saturday. It has been a long time kind of in the making, and it's like hundreds and hundreds of hours of testing these strategies and thousands and thousands of dollars, because everything I do, we fire off live trades. So again, it's theotrade.com/twist. Wow, these guys are excellent answering questions. So yeah, that question always comes up again, and about the IRA. Yes, you could do these in an IRA. All right. So yeah, if you've missed Slimmy, he's here at TheoTrade. So people are like, what happened to Slim? We scooped him. We scooped Slim. And again, a lot of people kept asking me about Jeff Bierman. Jeff left TD Ameritrade about a year. I don't know, about 13, 14 months ago. And he went back into, sitting at home and trading. So I keep in touch with everybody, and I just convinced him. I'm like, why don't you sit at home and trade? And like for an hour a day, just come on to TheoTrade, and he's loving it right now. So it's good. And believe me, there's one thing there's no shortage of here is going to be talent, because most people have like friends. Every one of my friends is a trader. I worked in Chicago for 15 years of my career. Literally everybody I know, okay, in and around me is a trader. So never going to be a shortage of talent out there. So anyway, with that, I want to thanks everybody for coming out over here. A couple of people are going to be watching a baseball game, it looks like. Let's call it an evening here. I want to thank everybody for joining us. There are a couple of questions. Doc is in here, Jeff's in here. They are answering questions feverishly right now. But again, hopefully I'll see most of you on Saturday at the class. If you can't make it live, it's recorded. You'll be able to watch it immediately. The archive takes only seconds for us to post over there. So stay tuned. Thanks, everybody. It's theotrade.com/twist. Have a great evening. Bye-bye.